To all, welcome to Officers Adda 247 YouTube channel. I hope everyone is doing good. So today is the third session where we are going to discuss some more concepts and just going to do some more numericals based on that, so that it will be useful for our upcoming examination. So before to start, just download the Adda 247 application and subscribe the Officers Adda 247 YouTube channel, so that you can get live notifications of the live lectures as well as the lectures. You can get quizzes. Okay, so just download the Adda 247 application and subscribe the Officers Adda 247 YouTube channel. Okay, so this is a question that is based on the ratio analysis chapter, and we have to just calculate the current ratio based on the following information. So before to start, just understand what are the ratio analysis and why we need for the ratio analysis. Okay, so first we are going to understand what are the ratio analysis. So ratio analysis is basically the analysis of the various pieces of the financial information which is derived from the financial statements. Okay, so what we understand by the ratio analysis, that is various pieces of the financial information which is derived from the financial statement, and it is basically the comparison of the items in the financial statements of the business. So if I am saying the what we understand by the term, that is ratio analysis. So ratio analysis is generally refers to the analysis of the various pieces of financial information. Please just write down or say please just maintain notes of whatever I am just going to convey here. Just maintain notes of the same, because the all thing I am discussing here, that's all important from the exam point of view. So basically, if I say what we understand by the ratio analysis, so it is basically the analysis of the various pieces of financial information that is derived from the financial statement. So if I, in short, if I say it is a comparison of the items in the financial statement of business, and it is to evaluate, it is used to evaluate liquidity. This is much important to understand. This is used to evaluate liquidity, efficiency, profitability, and solvency. And these are the some major category of for which we use the ratio analysis, that is to evaluate liquidity, efficiency, profitability, and solvency of any company or say organization. And it is mainly used by the external analyst. It is mainly used by the external analyst. So this is to all about what are the ratio analysis and why we need for the ratio analysis, to understand about liquidity of the company, to understand about efficiency of a company, to understand about profitability of a company. Okay, so there are different terms, and we have to just comparison of that items from the financial statements of any company. Okay, so there is a term that is solvency, what we understand by the solvency and what we understand by the liquidity, and these both are very important terms. So solvency is basically the ability of any company to meet its long-term debt. It is ability of any company to meet it is ability of a company to meet its long-term debt or say financial obligations. Okay, and what we understand by the liquidity, that is an enterprises or say that is organization's ability to pay short-term obligations or say short-term debt. That's it. That's it. That's all about the ratio analysis. Okay, so what we understand by the ratio analysis in quickly, if I say, that is the analysis of the various pieces of the financial information which is derived from the financial statements, and there are different terms, that is liquidity, efficiency, profitability, solvency. And if I say what we understand by the solvency, so solvency is a basically ability of any company to paying its long-term debt or financial obligations, and liquidity is all about the company's ability to pay its short-term debt or say financial obligations. All right. So in today's session, we are going to understand about because ratio analysis. If I say that is there are various type of financial ratios which is categorized in different groups, and in this session we are just going to discuss about liquidity ratio. So as I discussed, that is liquidity. It is any company's ability to pay its short-term obligations or say its short-term debts. Okay. So it is all about turning assets. It is all about turning assets into cash or say cash equivalents. So if I say that is about liquidity, that is the ability of any organization to pay off its short-term obligations. And in short, if I say that is all about turning assets into cash or say cash equivalents. So in liquidity ratio, we are just going to understand about current ratio and quick ratio. Okay. So understand about the current ratio, and if I say that is current ratio is equal to, that is current assets divided by the current liabilities. As I already discussed in my lectures, that is how we just derive the ratios. Okay, so the thing you always have to remember while just doing a ratio analysis question, you always have to just maintain numerator and denominator the same as the ratio's name. Like here that is mentioned as a current ratio. That means you have to try to just maintain a numerator and denominator in the same. Okay, or say in the same sense of the manner. Okay, you have to just write in the same sense of the manner. So if I'm talking about, that is about the current ratio, so we just write here that is current ratio will be equal to the current assets and divided by the current liabilities. Okay, so assets are also of the two types. One is that is known as a current assets, and another is that is known as a non-current assets. So what we understand by the current assets and what we understand by the non-current assets, just understand this. So current assets are all that assets that a company expect to convert into cash within a year. Okay, so what we understand by the current assets, that is that all are the assets that a company expects to convert into cash within a year. That is known as a current assets. Like if I say that is cash, bank balance, bank balance, our account receivables, inventory. Inventory means stock. Okay, stock. So that all are related to our current assets. And what we understand by the non-current assets, that is simply that cannot be converted into cash easily. That cannot be converted into cash easily. That is known as a non-current assets. And non-current assets mainly meant for long-term investment. If I am saying that maybe in the question, that questions may be asked like non-current assets basically refers to long-term investment, like our fixed asset, or say long-term investments, that all belongs to the non-current assets. That assets that cannot be converted into cash easily, that's all known as a non-current assets. And current assets that can be converted into cash easily within a year, that all known as a current assets, like cash, bank balance, account receivables, inventory. Okay, so inventory also known as a stock. Fine. Now come back to the question, and just we are just going to do current ratio question here. That is, we first have to know that is the formula of the current ratio, and we know the formula, that is current ratio is equal to current assets and divided by the current liabilities. So what how we just attempt these type of question, in the exam, you have to just recognize that is what are the current assets and what are the current liabilities given in the question. So like we have to just categorize into current assets and current liabilities. So inventory is a part of our asset as well as the current assets. So this will include under the current assets. Account receivables, that means amount that we have to receive from our debtors, okay, and it is basically in the terms of the bill of exchange. So account receivables also are a current asset. All right, after that, advanced tax payment, that also included under the asset terms, and that also will be our current asset. Okay, cash is current asset. Bills payable, that means amount that we have to pay. Okay, so this will come under the our current liabilities. Short term borrowings are borrowings, either short term or say long term, that would be known as a current liability. Okay, so now what we have to do, we have to just put the current assets, or say sum up the current assets and sum up the liabilities here. So in the current asset term, what we have to just sum up, we have to just sum up inventory. So just write here inventory plus account receivables plus advance tax plus cash. While in the liabilities, that is bills payable and short term borrowings. And borrowings are borrowings, either short or say long. That would all come under the liability section. So just we have to just sum up all the terms here, that is the inventory plus account receivables, advance tax plus cash. So when you just have to sum up here, so 50,000 plus 50,000 plus 4,000 plus 30,000, and in denominator side, that is 1 lakh plus 4,000. Now just sum up all these terms, that is all these numbers, that would be equal to the 1,34,000, and that would be equal to the 1,04,000. And further, if we are going to solve this would be 67, that is 67 is to 52. Okay, you can also write this 1.29 is to 1. All right, so this is the way how we just calculate a current ratio. First, we have to just categorize in the terms of the current assets, current liabilities, and after that, we have to just put all the values in the formula. Now, just attempt another question, that is about the, we have to just find out the current assets from the followings. So, tell me the answer of this. So, we know that the current assets are those assets that can convert into cash very easily, or say within a 1 year, that all the assets that we just convert into cash within a year, that all known as a current assets. So in the list of the followings, if I say, that is, we know that bank balance is our asset. Okay, asset as well as our current asset. Debtors are also our asset as well as a current asset. Bank balance are the current assets. Debtors are also the part of the current assets. Inventory means, that is inventory, that means our stock. Okay, that also belong to our current asset. Debtors, who is known as a debtor, that is those who take loan from us, or say purchase goods on the credit from us, so that all known as a debtors of us. So if I say who is known as a debtor, that is who took loan from who take loan from us, or say who take goods on credit from us, that all known as a debtors, and just we have to just receive the payment from our debtors. Okay, so that also a part of the current asset. So answer of this question, that would be the all of the above. Okay, now just attempt there is a one quick update from my side, that is we are just going to start a foundation batch, and it will be started from the 7th February 2022. By subscribing this batch, you will get a mock test, you will get ebooks as well as a live sessions, and in this sessions you just understand all the things from the zero level to the advanced level, and we just do the number of the questions that very important from the exam point of view. And this is also a very convenient price. That means you have to just pay 22% of the package, or say you have to just you can avail the 78% discount on the package by applying the code Y422. You can get this batch at the 78% discount. Okay, and so this batch is starting from the 7th February 2022, and you just can subscribe this batch. Okay, and this is especially for the English medium aspirants. Okay, so if you have not liked this video, please like this video as well. So this question is from the balance sheet equation, and this is most important question from the exam point of view. So just understand the concept, like how we just solve the balance sheet equation questions in the exam. So in this question, we have to understand the concept of balance sheet equation. So we know that is balance sheet equation. We know the balance sheet equation, that is assets equal to liabilities plus capital. Okay, this is known as a balance sheet equation. So we have to understand here some concepts, like if Ravi starts a business with 80,000 rupees. So you know, Ravi started a business with 80,000 rupees, and this 80,000 rupees will be cash for the Ravi as well as the capital for the company, or say it will be the capital for a business. Okay, so if Ravi is starting a business with 80,000 rupees, you also understand here debit and credit concept also for this particular line, because many times in the exam the debit and credit entry for that ask in the exam. So just understand this. If Ravi is starting a business with 80,000 rupees, that means here two type of account included, that is cash account as well as a capital account. Okay, so if Ravi started a business with 80,000 rupees, that means this 80,000 rupees would be cash for the Ravi as well as a capital for the business. So if in this equation we have to just put this 80,000 rupees, how we just write here, that will be what? This 80,000 rupees will be cash for the Ravi. Or okay, and meanwhile Meanwhile, currently there is no liability mentioned in this line, so we just skip the liabilities portion. We just write down here that is capital. Okay, so just write here that is capital, 80,000 rupees. After that, it is written that is then purchases goods from Vinod on credit for 21,000 rupees. So here clearly mentioned that is goods are purchased for credit. Goods are purchased on credit for 21,000 rupees. That means now it is mentioned as a liability for the company, isn't it? It is liability for the company, as well as, if I say that is a liability for the company, as well as because goods are purchased, so it will also be a part of our inventory. So suppose that I purchase goods on credit from this person. So this person will known as a creditor, and I will known as a debtor. Okay, and I purchase goods on credit for 21,000 rupees. So if I purchase goods from for 21,000 rupees from this person, that means this 21,000 rupees will be the liability for the company, isn't it? This 21,000 rupees will be the liability for the company, and what I purchase, that is a goods. Okay, and that's good is about 21,000 rupees, so that also be a part of our assets, isn't it? That is also a part of our asset, or say because now these goods are known as our inventory, or say these goods are known as our stocks, so that also be a part of our assets. So how we just represent here, that is 80,000 rupees plus 21,000 rupees, that is a part of the stock. Okay, or say that is a part of the inventory, plus also equal to, that is now liabilities here included. So liabilities would be, that is about 21,000 rupees plus capital, that is 80,000 rupees. So this is the first equation, or say this is about a first line and this is about the second line, or say this is the final line. So if I say that is a total assets what I have, that is 1,01,000 rupees are the total assets which I have. And if I say that is a liabilities and capital, that is liabilities are of 21,000 rupees and capital are of 80,000 rupees. So this is how we just maintain a balance sheet equation, or say make the balance sheet equation. This is how long is the period of grace in the case of bill of exchange. So as we know that a bill of exchange is a written order by which one party pay a fixed sum of money to another party on demand, or say at predetermined date. At predetermined date. So this is known as a bill of exchange. That is, it is a generally a written order. It is a written order by which one party to pay another party a fixed sum of money at a predetermined date, or say on demand. So that is. Next question is, how long is the period of grace in case of bill of exchange? So as we know that a bill of exchange is generally a written order by which one party to pay fixed sum of money to another party on demand, or say at predetermined date. At predetermined date. So that is known as a bill of exchange. So the bill of exchange is generally a written order, that is by which one party to pay fixed sum of money to another party on demand, or say at a predetermined date. That is fixed sum of money. So that is basically a written order, and in the bill of exchange there is a term that is known as a due date. So due date is basically the date on which bill is payable. So that is known as a due date. And on this due date, the extra 3 days also given, that is known as a grace period. That is known as a grace period. So on this due date, the extra 3 days also given in the bill of exchange, okay, for arranging the money. So this known as a grace period. So we can say that the answer of this question will be the, how long is the period of the grace in case of bill of exchange? So answer will be the 3 days. So 3 days would be the answer here. So that's all for this session. I hope you like this session, and if you like this session, just hit the like button and subscribe the channel also. You can also join us on the Telegram channel. So thanks for watching this video, and if you like this video, hit the like button, and now we will meet in tomorrow's session at 6:30 a.m. Meanwhile, if you just want to join foundation batch, you please do not forget to just apply coupon code, that is Y422, and with this code you will just avail 78% discount. Okay, so now we will meet in tomorrow's session.